This is a presentation on accounting and auditing principles. Accounting and auditing are interconnected fields that are useful to manage and to verify financial activities in organizations. However, they have different principles and assumptions guiding them. The accounting principles include entity concepts. The entity concept states that the owner of the business is different from the business. The entity concept separates the business from the owner. We have the going concern. The going concern assumes that the business will continue to operate in the foreseeable future and will continue to operate without collapsing in the near future. We have the materiality principle or concept. It focuses on significant financial misstatements or omissions. We have the periodicity. This concept talks about measuring financial performances within specific periods. For example, in Nigeria, it's January to December fiscal year. We have the realization concept. The realization concept states that when an order is given, money is realized. We have the matching concept. The matching concept aligns the income and expense within the same financial period to ascertain the profit or the loss. You have the consistency principle. The consistency principle states that businesses must be consistent in their decision and action. For example, if they decide to use straight line depreciation method, it is expected that they continue with that method over time. Another principle is the historical cost principle. The historical cost principle cost assets as at the date of purchase. This is usually to have a fair reporting. We have money as a common denominator. Every transaction must be equated in monetary terms. We have the duality concept. Every transaction must have a debit and a credit entry. And lastly, we have the prudence conservatism. This focuses on prudent reporting and the judicious use of resources. Now, the auditing principle includes integrity. Integrity expects that the auditors must maintain honesty, must be truthful, and possess good reputation. We have objectivity. It expects that the auditors must issue their report without fear or favor. We have independence. This principle expects that the auditor must not have any interest in the firm he is working. We have skill and competence. It expects that auditors should be certified and qualified accountants and should be able to interpret the work done by others. It expects that the auditor should be able to review accounting systems and internal control and draw a conclusion. Another principle is planning. It expects that auditors should plan their audit tasks adequately to achieve timely and reliable results. And the last principle is documentation. This expects that auditors should keep proper records of audits maintain proper documentation for future record purposes. In conclusion, accounting principles ensure accurate financial reporting. However, auditing principles uphold the integrity and the reliability of this report. Together, they promote transparency and truth and trust in the Nigerian financial system.